Thanks again for having us here, and I think really excited for this panel this afternoon. I'll just give you a brief intro to myself and the work that we're doing at USAID in this area, and then tell you about our panelists, and then kick it over to them. And I think that the subject today of asset finance has been increasingly important in this sector, and we're hoping to really dive into some of the details and get a good conversation going. So I'll start out with a couple of broad questions and then let these guys take it away, and we'll try to save quite a bit of time at the end for conversation and questions from the audience. So just to give you a quick sense of one of the things that we're doing at USAID in this area, I work with Development Innovation Ventures, and this is the agency's internal venture capital fund. So we have a portfolio now of about 80 organizations around the world and 30 countries across a dozen sectors, early stage social enterprises that are experimenting with innovative, novel approaches to development. And about 20 of those are in the off-grid energy space, including some of those here today, like Simpa and Solar Sister. Across different forms of technology, different stages of the business cycle. And so we've been learning quite a bit about this space, and what comes up time and time again is that asset finance is really key, and there are no easy answers. So it's a capital-intensive business. Often there are complex demands for financing, and this sets up some big challenges, and each of these companies have gone through that in slightly different ways. So let me give you just brief introductions to our group here. I'll start with Peter, who has maybe the business model that will be the most familiar to you. He's the CTO and co-founder of SolarNow, based in Uganda. Been working on that since 2011, but comes to that from a background mainly on the nonprofit side and working a lot with rural communities in East Africa. Then Paul is the CEO and co-founder of another company, as I mentioned, Simpa Networks, based in India. They're based in Bangalore. Started that in 2010, and he comes really from a background of running several startups, not all in the renewable energy sector, but in across a series of different sectors. And then closest to me is Sam, and he is the co-founder again and CTO of SteamaCo in Kenya. And has been working in the renewable energy space for quite some time, has a PhD in the area, and started that company also in 2011, and it's a little bit different business model, and he'll explain that to us. But I think we'll start with Peter, and perhaps you can just give us, each of you, but starting with you, kind of the 1 to 2 minute explanation of the business model, and in particular talk a little bit about the technology that you use and who your customers are, and then we'll get into the financing parts of that later.
Okay. Well, thanks for the introduction. So yeah, SolarNow is what you would probably call a traditional asset financing company, closest to like what an MFI traditionally does. We sell like high quality solar home systems in the slightly larger range to power lights, televisions, fridges, traditional electrical appliances, and we do that with a 24-month credit facility. So we do a credit screening up front with our clients. When the credit gets approved, we install the system, and the client starts repaying us on a monthly basis until he has completed his credit. Systems are all modular, so clients can upgrade their systems over time. So they can start with a relatively small system and basically expand it as time progresses. So like I said, we focus only on high quality. So because we're doing slightly larger systems as well, we don't typically target really the bottom of the pyramid. It's really the rural middle class that we target, who are then servicing or selling their systems, using them for income generation, charging phones, running barber salons, things like this. So we do that through a network of 35 branches in Uganda with around 200 staff. So we employ all our salespeople directly, which gives us a great amount of control over how we sell, gives us a great amount of control of the service that we offer, and managing basically the credit portfolio. And we typically profile us as really, and it was like mentioned in one of the earlier panels, is like, indeed, people don't care about like brand awareness, which was indeed contradicted. We also see the same. People value brand, like they do like put trust in a brand, and that's typically how we profile ourselves, really as the brand that you can trust, the brand that is really out there. If you have a problem with your system, it is a technically complex product. Like there will be problems. It's really about being there when the problem occurs and helping that client solve the problem when it's there.
Great, thank you. Paul, I'll hand it over to you if you want to talk about Simpa.
Yeah, sure. We operate in India, so we're Simpa Networks is our US company. In India, we have Simpa Energy India. We're in India because there's a huge market opportunity there. There are probably 100 million unelectrified households in India. Probably another 100 million households with extremely unreliable access to the grid, maybe getting 12 hours of power a day. So as I think Nikki pointed out, once you've got a little bit of electricity, when it's taken away from you every day, that's extremely frustrating and a big motivator for people to look for a reliable solution. We also work with very high quality solar home systems. We don't just say that. Neither of us are just saying that it's high quality. It's really important to our strategy to sell high quality because you're financing with a sort of a credit sale model. We're actually leasing our products to our customers. So in our model, we own the solar home systems. Our customers pay for the right to use them. It's basically they're renting them from us with the option to buy them. So we fully expect that almost all of our customers are going to ultimately own their systems. They say they want to, but so you can think of it as a lease-to-own model. We have about 300 people on staff. We have about 14,500 customers today. We're growing at about 10% month over month. So we're in a very rapid growth phase right now. We have customers in about 1,500 villages so far. We're operating in a tiny corner of one state in India, and all those customers have been added mostly in the last 18 months. So the sales, once we figured out our sales model, we've just had a great sales growth. We sell through local village level entrepreneurs. We call them the Urja Mitra, your energy buddy or your energy friend. These are successful local entrepreneurs that we recruit, train to sell solar. So this is important. We're not trying to create solar entrepreneurs. We're trying to recruit entrepreneurs and teach them how to sell solar. We also recruit and train from the village areas young men, typically, to become our solar technicians. So all in, we've got about 300 people on payroll. We've got about 1,000 people off payroll as technicians and solar entrepreneurs.
Great, thank you. Sam?
So my name's Sam Duby. I work with SteamaCo. We're based in Kenya. It's great to see some fellow Kenyans in the audience. Imagine Obama will probably be poking his nose in earlier if he's not too busy. It's really interesting hearing about all these challenges because the story of our evolution has really been one of iterating and responding to a lot of these challenges. We started off in Kenya 4 years ago trying to teach people how to build their own wind turbines out of scrap materials. We realized very quickly that the quality issue was primary. It was never really going to work. So we started building our own wind turbines and selling those. Then the problem was one of affordability. People couldn't afford to buy these things, so we started looking at innovative leasing and financing models. We realized eventually that actually what people wanted to buy was power. They didn't want to buy the technology themselves. So we thought, why don't we just build the power stations ourselves and just sell what people want, which is the power. So we started building village-scale solar power stations, connecting all the villagers and their businesses to this power station, and they buy power using the ubiquitous M-Pesa networks. I'm sure most of you in this room are probably familiar with M-Pesa, but if you're not, M-Pesa is everywhere. It's a way of putting money on your telephone. Everybody in the most rural areas has it. It's an incredibly revolutionary banking system. So people use M-Pesa to buy power from us in the same way that they buy airtime. They just send us some money, their line turns on. We're creating energy vending machines. This was successful, and we realized that actually our key piece in this puzzle was the technology that allowed people to do this. So we decided to specialize, and what we now do is we provide the tools for other people to build these microgrids. So anyone who has the skills to put a solar panel on a roof can now access the much wider market of rural people who need energy services by using our technologies, which consist of hardware and software, to run effectively these energy vending machines. We're selling energy as a service, and they can then sell energy as a service rather than a product, and we provide the tools in order to do this. This was a great move because it made us a lot leaner. That was another word that was mentioned earlier, and we're now able to operate internationally a lot more easily. We've got lots of different flavors of projects, and we'll touch on to that later, but it's really allowed us to scale. It's been the single biggest mechanism to allow us to do that.
Great, thank you. And I want to pick up on that and put another question to the full group, which is really about your asset financing in particular, and about your fundraising strategy and how you think about piecing together the various types of financing that you need in order to fuel the growth. And I know you're all at pretty rapid stages of growth, but with somewhat different business models. So I guess not only talk about what you're looking for in terms of the mix of debt and equity and potentially grants. I know I learned from the last session everyone wants grants. But also how that links to your strategy. And Sam, I think we'll start with you, and feel free to talk about not only your business but some of your clients' businesses and how that informed your strategic shift to be more of this service provider.
So we would have been very much in the yes please grants camp at one point. Since our shift, we've become a B2B company. So we're not necessarily dealing directly with the end users ourselves. We're dealing with companies and donors and anyone who wants to build a microgrid. We're dealing with them, and they then deliver these services. So in a way, we're slightly insulated from some of the funding challenges that other people here face. But what that means for us is that we have to build the tools that they need in order to attract this funding. So whether that is online financial forecasting, so they can show to their investors absolute transparency when they're going to get return on investments, all those financial and analytics tools in our dashboard, or whether it means that we need to be able to show impact. For example, we get a wide variety of people who are buying our products and our services. Some are looking more for impact, some are looking more for financial returns. We are incentivized to build the tools that allow them to do that very well. What this means is that we're very light, so we are not looking so much for capital so much. We're looking for ourselves for equity, but also we're looking to link up our partners and our clients with finance. And that's something probably, again, we'll talk about a little bit more. But again, we're really trying to be the platform that links all these players together. So we've got the mechanism by which people can buy power using their phones, so rural end users can have access to these services. The mechanism which de-risks and makes transparent for investors to be able to track their investments from afar. The mechanism that allows local solar installers to access a much wider market. And also the huge amounts of data that is coming from our system is a mechanism for donors to provide interesting mechanisms like data-driven results-based financing. So we're really trying to be the platform upon which a lot of these stories are played out, and financing is just one part of it in all of its various flavors.
Great, thank you. And I imagine the story is pretty different for the two of you, so would love to hear your perspective on companies that are really a lot more asset intensive.
Yeah, so indeed, we're extremely capital intensive. I mean, we source all our products directly from China. I mean, it takes on average 4 to 5 months before products reach Uganda, before we can start selling them. It takes a month to 2 months before products are sold. And then it takes another, around 10 to 12 months before we actually earn back the investment on the stock that we purchase. So indeed, extremely capital intensive. So I would say we're definitely not in the yes, please give us grant money category. We're actually almost allergic, although we're not dogmatic in it, but I mean, we're almost allergic for grant funding. One of the main goals of starting SolarNow is to actually prove that you can build a commercially sustainable company that you can bring to scale without grant funding. So how do you really build a commercially sustainable company? How do you scale it? And how do you attract funding for that? So there is a place for grant funding. I mean, like ARC Finance has supported us also, but it really needs to have a really confined space within the company, like preventing startup losses, for instance, by developing an ERP system, but extremely contained and definitely not for working capital purposes. Then if you look at like funding needs in general, I mean, it needs to be a healthy balance between equity and working capital, of course. I mean, if you don't have a solid equity base, like no one is going to put working capital in your company, especially not once you start growing. So it's been always a little bit a balance between finding the right kind of funding. If you look at the working capital needs, again, it's a balance. We mentioned it, or it was mentioned earlier. It's very much about a balance between local currency versus hard currency. Particularly in East Africa at the moment, local currencies are devaluating. I mean, more than 10% in the last 6 months. I mean, you need to have local currency solutions in place to be able to fight that, so to say. So it's really, it's not a clear-cut answer. It's really like you're constantly looking for the right balance. The balance shifts all the time, like what we've seen recently with the currency devaluations. And then it's also a little bit, like availability driven. I mean, like what kind of funders are interested? Like how do you interact with them? What kind of funding are they willing to offer? Under what kind of terms? So it's not a clear-cut answer, but it has to be a healthy mix of the various forms of funding.
Yeah, great, thank you, and thanks for bringing up the FX point, because I do think the local currency issue is certainly one that impacts everyone in the space. And so, Paul, I know you had some thoughts on that as well, but would love to hear around this balance issue and how you think about that.
Yeah, well, I'll just highlight that I think many businesses like ours need a lot of capital to scale. I mean, let's face it, the technologies to provide universal access to energy already exist. The problem is they're too expensive, and they therefore need to be financed for the end user, right? The energy poor also tend to be among the poorest people in their own countries. They're not going to pay cash for that. You know, in our case, about a $400 system. I think in your case, even bigger systems, our customers aren't going to pay cash for that. We need to finance it. So when we started the business, we started with that realization that not only do we need a really compelling product that people want to pay for, and not only do we need to build a sales channel to go acquire those customers and service those customers, we also need to figure out how to mobilize that capital. So we need a really strong value proposition for the end user, and we need a very strong value proposition for the channel. In our case, the sales agents, they have to be incentivized to do it. They need a compelling reason to work with us. And we need a compelling value proposition for the investors that are providing the capital that allows us to buy this solar equipment that we then lease to our customers. So right from the beginning of the company, we realized that, wow, there's 3 big problems to solve here. We gotta solve for the customer, and solve for the channel, and solve for the investor. So when we thought about it that way, we sort of put all of these parties on equal footing. I think a lot of companies, maybe a decade ago or 5 years ago, came into this sector with a product focus. You know, if they could develop, they thought to themselves, if we could develop an amazing product, then it would sell. And we took a different approach. We said, you need a product that people love, but you also need a channel to get it to those people, and you need to finance it. So you got to solve all those problems at the same time. And when we looked at it that way, we thought, okay, we need some, for this to scale, we need some sort of risk mitigation strategies, right? If we're going to deploy all these assets on credit, or in our case, leasing them, we need assurance that those customers are going to pay. How else am I going to be able to go to an investor and say, please lend me money so I can buy a whole bunch of solar equipment and put it out on lease into rural India, far away from where your offices are and where your 5-star hotel is? Like, you're never going to meet these customers. So how can I provide that assurance to the investors that those customers will pay? So we took the approach that we needed, that this model would be greatly helped if we had some shut-off technology, basically a way to disable the device when it's time to pay. Just like a prepaid mobile phone. You know, you top up a mobile phone, it works until you run out of credit, then it stops working. that's how our solar systems work as well. So we integrate this prepaid metering technology into the system that shuts it off. I say that because, from a capital raising perspective, we felt that was really important. We looked at the market opportunity in India, the 100 million unelectrified households, and we thought, wow, that's a multi-billion-dollar industry there. That will be billions of dollars of distributed solar assets generating revenue. And if you're going to aim for something at that scale, you've got to really think about operating efficiency from day one, and you've got to sort of figure out how you can use technology. I think many of our businesses require broadly 2 or 3 kinds of capital. We need capital for operating expenses, for OPEX, for wages, for marketing, for R&D. That's the OPEX. And for that, we raise equity. We've also been fortunate to get some grants along the way towards OPEX. But the tougher nut to crack is the CapEx. We invest in this solar equipment that we're leasing to people. And the bigger we are, the more of that we're going to need. And that sort of scales linearly. If we want to double the number of customers, we need twice as much capital for that solar equipment. For that, we ideally raise debt, and we've been able to get to that point. We used to, when we started, we used a bit of equity for that, and then we used some grants for that, but we finally graduated to beginning to mobilize debt for the CapEx.
Great, thank you. And I think there are, across these, a lot of themes that I want to pick up on. But one of them, Sam and I were discussing a little bit before, Paul was talking about addressing all those concerns and having to look at the channel, the customer, the investor, kind of a holistic view. And in many ways, we see some aspects of vertical integration in the industry. But I think you have a little bit different view on that and where you see that it might go forward, and certainly your business is a little bit more along the specialization track. So I'd love to hear your thoughts on how that's playing out.
Sure. So I find myself saying this quite a lot, but I cannot reiterate it enough. The world is changing, and it's changing really fast, and that's why it's really important to have practitioners speaking to donors and people like you guys, because things are moving really fast on the coalface, and innovation is happening all the time. We're an example of 3, but there are hundreds of us out there. We have realized through our journey that it's made sense for us to specialize on what we're good at. I mentioned before that we were developing projects ourselves. We were putting solar panels in the ground, we were finding villages, we were doing everything, developing the meters, everything from A to Z rather than Z. So we realized that this was actually not a very efficient way of working. So we decided to specialize on what we did really well, which was the technology, providing the platform that allows this mobile payment integration, allows this financial transparency from an investor perspective, and allows people to be able to manage and run these microgrids from afar. We specialized on that technology and allowed other people to do that. I think that's the future of this space. I think we're going to see much more of this specialization, fragmentation, and collaboration going on, whether it's people developing financing mechanisms specifically for microgrids or financing mechanisms specifically for small home solar systems. I believe that fragmentation is inevitable. If you look at it historically across other sectors, it's what happens. And I think we're going to see more and more of that. And I welcome that, because I think it means things are going to happen much more efficiently, much more transparency. And I think people work better in collaboration like this than they can on their own. Nobody can reinvent the wheel 300 times.
Great. Yeah, thank you. And I think in some ways the Kenyan market is more advanced than some of the other markets. And so I'm curious if you have any responses to that based on the Indian or Ugandan context, and where you see that playing out perhaps differently based on your experiences to date.
You want to? Yeah, sure.
Well, I would love to. I mean, like we do everything. I mean, we go to China ourselves, we do the financing ourselves, we do the installations ourselves, we do the collections ourselves. I mean, it's lots and lots of work. But unfortunately, we have to at this point. I mean, we've also tried working with more traditional MFIs. We've tried working with savings associations. It's been extremely difficult building those kind of relationships. And even like when there is an initial partnership, there are so many challenges on the way, making sure that you understand each other, get these collaborations off the ground, make sure they get some momentum, which requires also lots of effort and pushing on our end. So that's why we've stayed relatively vertically integrated ourselves. We do try to bring in lots of expertise from outside, bring in human resource expertise, like how do you motivate, incentivize staff, like something that came up during the previous channel. Work with sourcing partners in China that help us control the quality. So we do try to bring in that knowledge, but we have found it, particularly in Uganda itself, extremely difficult to build those kind of partnerships. If you want to offer like a product like this on credit.
Yeah, I think the journey that you've been through is the key, because you came to a place where you knew you could specialize after having tried a bunch of other stuff. We've also been on a journey too, and actually we tried to specialize and do a B2B business model for a while. We got so excited about this prepaid metering technology that we had developed for ourselves. We thought, wow, couldn't we sell it to other people? Couldn't we sell it to other solar home system companies so they could offer pay-as-you-go or leasing to their customers? Couldn't we integrate it into solar microgrids so other companies could operate the microgrids and we could just be that technology provider? We had investors who invested on that basis. They saw that as what was so exciting about our company. And now still I have different members of our board of directors who invested for different reasons at different times in the company as we've followed our journey and discovered our business model. We piloted with microgrids. We integrated, we picked two really strong partners in India that were building and operating microgrids and needed this prepaid metering technology. When we started working with them, they said, everything is fine except payments. We've figured out how to run microgrids profitably. The problem is customers don't pay. And if we could just shut them off when they don't pay, we think everybody will pay. So we integrated our metering technology into their microgrids. And we then realized that those companies had other challenges scaling. They had challenges acquiring land rights. They had, there's communal tensions within the village. And if you put the panels on this guy's roof, then this half of the village won't buy services from you because they're from a different caste. They had problems raising the capital that they needed to scale up. So we got a few microgrids working well, but our partners, that is our customers buying the technology from us, were unable to organize all the other resources they needed to scale up. So we took a cold, hard look at that at the time. This was in about 2013, and realized that even if our technology did everything it was supposed to do, there weren't enough companies in India building and operating microgrids for us to build a business selling technology only. We had inquiries from around the world for the technology too, and when we looked closely at the companies that wanted to use our technology, we could see that most of them hadn't figured out where they were going to raise the money from. They didn't know how to raise equity. They hadn't raised the debt. They had a great idea, but they had no traction. So this was, a few years ago, and our perspective at the time was we couldn't build a business just selling the metering technology. And our technology was not as sophisticated as what you've got, because I've seen and heard more about what you've got. So we were much earlier stage. But we also tried partnering with other companies for sales and distribution. Again, trying to just own a smaller piece of that value chain, and had similar problems. We just had real problems with partner execution risk. We wanted to sell this way, they wanted to sell that way. We wanted to incentivize the sales organization with sales contests. They said, no, it's our sales team. You can't give commissions directly to our sales team. We wanted to distribute new marketing material. They said, we only distribute new marketing material once every 2 months, so wait. So lots of little things like that. We found challenges working with partners, and we went back to our board of directors and said, you know what? We all wish we could focus on just one piece, but what we're trying to deliver to the customer here is this complex customer experience, and it's not only the customer, it's also the channel, and it's the investors. We need to control many more pieces in the value chain, at least for a while, until we figure it all out and understand the different pieces, so then we can figure out where we can partner. today we are signing an agreement with a bank in India that will be actually lending to our customers. So up until now, we've been borrowing money so we can lease the systems to our customers. But we're beginning, it's just one bank, and it's a small, well, it's not too small, it's a $5 million deal that we're signing with this bank. But it's a relationship where they're actually lending to our customers. So that's one piece of the value chain where we're starting to outsource through a partner. And our hope is that as we scale up, as we gain more experience with the different pieces in the value chain, we'll find where we need to stay focused and where we can partner. But we thought, at least for a few years, we need to own most of the value chain to figure it out and scale up.
Can I say one thing to that? I think one of the things, again, that we often say, which counted in our favor, is that in Kenya, we were building on the shoulders of giants, we often say. M-Pesa was everywhere. M-Pesa is a hugely revolutionary technology, and our business model would have been impossible without it. So we had that advantage. We did not have the problems of competing mobile networks, so we already had that. The other thing to deal with the simplicity of it. You mentioned a complex user experience. We're trying to decomplexify it as much as possible, to coin a phrase. So we're trying to give people better than grid services. The electricity they're getting out of the socket in their house is the same, if not better, as someone in an urban area. The way they're paying for it is the same, if not better, than someone in an urban area. And again, people are very culturally used to buying services on their phone. So maybe that was a difference. But again, once the momentum starts building in somewhere like Kenya, it starts spreading. You look at the spread of mobile money platforms around the world. It's been like wildfire. And I think as that understanding and as that appreciation increases, so these interesting business models will grow and mushroom, I think.
Yeah, agreed. And I want to just circle back to something that Paul was discussing and maybe go into a little more detail. I think this new banking relationship is an interesting potential here. And we've all spoken about the balance of fitting together the different pieces of the funding puzzle. And I know often we talk about the chicken and egg of can you get equity if you don't have debt, and can you get debt if you don't have equity? And so I'd love to hear you talk about that a little bit more and take it down one level deeper about how you've been able to navigate those different pieces in a very difficult situation.
Yeah, that's been really tough. That's been very difficult. Again, many companies in this sector are dealing with the same problems. You need debt to finance the assets that you're renting or leasing to your customers, and you need equity to grow the business. The debt investors say, come back and talk to me once you've got the equity. And the equity investors say, come back and talk to me once you've got the debt. And it's been very difficult to move those two parties along. I mean, if you're a debt provider, why invest the time and due diligence to get to know this company if the transaction is unlikely to materialize? So they need a certain confidence even to have a meeting with you, let alone to begin a rigorous due diligence process. They need a certain confidence that you'll be able to raise the equity. And similarly, on the equity side, the equity investors won't waste time talking to you unless they think, okay, this team's going to be able to figure out the debt. And then all of that money has to come in at about the same time. It gets worse. Not only do you need this long-term debt for the solar assets and the equity for the OPEX, we also need short-term working capital for the sorts of things you talked about. We need to pay suppliers in advance. Then it comes on a boat from China, or sometimes we have it manufactured in India. So we have 90 to 120 days of inventory. We need short-term working capital for that, which is not long-term. So different lenders provide that kind of capital. So it's not even a chicken and egg and a question of which comes first. It's more like a butterfly and a caterpillar and an egg. And you've got to get them, we don't know what comes first, but we're always trying to move all of them along, assuring each party that we'll organize the rest, and it's coming. In that context, we realized that we should aim for some very high-profile, very good quality investors, that if we could get them, that would signal to other kinds of investors that we've got the right kind of relationships in place. So we reached for the sky. I mean, we went for a relationship with USAID. We went for a relationship with OPIC. We went for a relationship with the Asian Development Bank. Schneider Electric is one of our investors. Vinod Khosla with the Khosla Impact Fund is one of our investors. So we've sort of gone for brand, recognition on the investor side. So now when we talk to debt investors, they see the quality of equity investors that we have, and they see that our equity investors have typically reinvested whenever we've needed more capital. And on the equity side, when we go looking for bigger equity investors, they can see, oh, this company's already got a transaction with OPIC, and they already have a relationship with Asian Development Bank. So we've got these, very scalable partnerships there. But each of those partnerships took at least 2 years to develop. And this is where grant funds have come in and helped us stay alive while we pursued the big fish, or the sort of ideal scale investor partners. Because those relationships took a couple years to develop, and in the meantime you're sort of burning through your equity. We were funded by really early stage sort of angel investors initially, and social impact investors that all typically make very small investments. So yeah, it's been complicated and hair raising and hair losing, sort of a race on my head between graying and thinning, and nobody wins. But we've aimed for really good quality investors. That's taken time.
Yeah, thank you. And Peter, I'd love to hear your thoughts if you want to continue to expand on that. But also, specifically, I know that one of the things that many investors are concerned about is mitigating their risk. And would love to hear you just explain a little bit how you measure risk and how you think about controlling for that in your portfolio and communicating that externally to investors, but also for your own management team.
What you were saying, Paul, sounds incredibly recognizable. We've gone through the same dance. I mean, we've been really lucky with early stage investors like Alpha Mundi here in the room. So also providing bridge loans when it was needed, when we were really in this dance together with new investors, trying to get them on board. So it's you're constantly busy with trying to attract the right kind of capital to keep the company going. So with often limited management capacity, so it's extremely intensive. But we've come to while trying to run the company, trying to make it grow, trying to find out what the right business model, distribution model is. So it's an interesting challenge. Has been an interesting challenge. Maybe to add on to that, the raising of the local currency loans. I mean, we've been focused on that a lot, particularly with the help again of ARC Finance and the DCA facility of USAID, to really see how we can build a more diverse capital portfolio, so to say. And again, lots of discussions, trying to understand each other, seeing how you can match affordable funding to the need of the business with appropriate tenures, repayment periods, etc. So yeah, it's a constant dance, so to say, to get it all together and to get into sync. Then to maybe reflect a little bit more on how do you manage risk, particularly around portfolio health. We're in that sense quite traditional. We really take look at our clients really as a credit portfolio, almost as a bank would look at their portfolio. So we look at really traditional metrics like portfolio at risk, repayment behavior, on-time payments, and basically analyze our portfolio as such for our own good, but also indeed for investors. We really believe that we need to have a healthy portfolio with repaying clients to be able to bring this to scale at some point, and maybe focus a little bit more effort and maybe not grow as fast in the beginning, but making sure that is in order before we start scaling, and make sure that we have basically a controllable portfolio that we can grow when we're ready for it.
Yeah, thank you. And Sam, we were talking a little bit just before this about tech tools that companies might use in order to communicate around that risk and around some of the key metrics that investors would be looking for, and potentially ways you had mentioned in some of your earlier remarks around data-driven investing. And it would be great if you could expand on that a little bit and think about how those types of tools might facilitate more finance coming into the space.
So I mentioned, first of all, the fact that data provides transparency, which I think is key for investors. They like to know where their money is, what it's doing, how it's coming back. I think that's quite obvious. So displaying that, making that visible is one concern. But going to the more exotic uses of the data, something we've been talking about quite a lot recently is that this huge amount of data that's coming from projects like ours, whether it's small home solar systems, microgrids, a lot of people are using Internet of Things, database services to keep track of their customers, to manage their grids. A huge amount of data is coming off now. One of the more interesting applications of this data that we've been talking about is using it to bring lots of the different players in the room together, focused and in concert. So, for example, one such mechanism might be for myself as a microgrid developer, go to DFID or USAID with a piece of paper and say, sign this to say that you are going to subsidize 50% of every kilowatt hour I sell, transparent, certified sale. You sign this document, it costs you nothing to do this, very easy. I then go to my investors and say, look, I've got a de-risked investment option here, got subsidized power, give us some money, it's going to stop in 6 months, we need to move now. They provide the investment for me to build a microgrid. I can build a microgrid, and again, I'm incentivized to do this very, very quickly, and I can start selling power effectively at half the price. So it means that it lowers the barrier of entry for end users to get involved. What it means also, because we're using a third-party payment mechanism, there is that transparency already there. So when a customer makes that payment for a kilowatt hour from me, it routes through your servers. You basically double that money and route it to me. So it becomes a very low-risk way of you having very targeted results-based financing. It's a way of me getting much easier investment, and it's a way of my customers accessing these services at a much lower price. So simply using this data itself and the huge volumes of it and the third-party services that it implies, you open up a lot of possibility for target-based, results-based financing and bringing all the players in the field together. Data is huge, and I think it's only going to grow.
Is this something that would be viable at SolarNow or Simpa, and something that you think your investors would be receptive to, or are there other types of ways where you can help them to get more comfortable with the risk, either by leveraging technology or through other means?
Yeah, well, that may or may not work for us because the kinds of grant funds that we've received have been, they haven't really subsidized the cost to the customer. It's the grant funds have been targeted more towards, received a grant early on from ARC Finance to develop our first prototype and to do some market research way back in maybe early 2011. We received a Development Innovation Ventures grant to scale up and launch into a whole new territory. But none of that subsidized the cost to the customer. I do see that sort of cost subsidization approach being used by some microgrid organizations in India. So we spoke before about Rockefeller Foundation that's really investing heavily. They want to build 1,000 microgrids in India, and they're putting money into it, knowing that once we build 1,000, we'll know how to do it, and it ought to be commercially viable. Like, we ought to figure out in that time how to do it commercially viably. When I say we, I mean they are investing that way. Concessional capital would be useful for us in different ways today. What we really want to do is unlock capital in India. We're borrowing internationally today. We're exposed to the currency fluctuations. What we really want to do is unlock commercial banks in India. So they will lend either to our customers or lend to us so we can lease to our customers. They're very conservative. They're looking for 2 or 3 years of profitable operating history. We're trying to grow as fast as we can, so we're not profitable. Loan guarantees, I think, could help. This new banking partnership that we have, the bank is looking for a 10% first loss guarantee. So we put money on deposit with the bank. So we take the first 10% risk. We could use grant funds for that, for example. I think those are the ways in which so-called soft money could be useful for us. Maybe also just for the market development, marketing, training. We're recruiting so many solar entrepreneurs and solar technicians, and we invest quite a bit in training them. Some of them work with us for 6 months and then go off and work for somebody else. So everything we've invested in training them to become a solar engineer is now being captured by someone else in the economy. But that's the nature of the Indian job market today. You're lucky if you can keep someone for 6 months or a year, because the economy is growing so quickly, people are just jumping from one opportunity to the next.
Feel free to jump in, and I'm just going to open it up next. So,
Yeah, I want to comment maybe on the driver of data. I mean, we also really strongly believe that data will drive the company. I mean, our ability to really know our customers, how they use their solar systems, how they're actually repaying. I mean, that kind of transparency will in the end drive our ability to attract more capital, to set up innovative financing models around special purpose vehicles, or, well, you name it. I mean, that kind of knowledge of our customers will really drive how we will do our business over time. And that goes from understanding the customer, how do we acquisition new customers, where do we find them, what type of customers are they, up to how will they, being able to predict how they will repay over time. Maybe using that kind of data to relax our credit scoring methodology, maybe be a little bit take a bit more risk maybe with certain clients, because we know that their repayment capability is better than others. So indeed, I think data will be a really strong driver for how our type of businesses will develop over the next few years, especially now that we're actually collecting data. I mean, you were talking about nearly 15,000 clients. We're talking about 10,000 clients. Look at the Mcopas, the mini kits. I mean, they have 250,000 clients. Just imagine the richness of that kind of data and what we can learn from that on how these clients are actually using their systems and what their real financial capabilities are, and how they respond to the technology. So I love this, but that's also a little bit my background as CTO and data analyst. So.
So let me expand on that and just say that we are really interested to hear from other people about how to use that data. We're very open to sharing that, because you guys will have ideas that we've never even thought about. So we're able to see individual customer repayment patterns. So we're able to see customers that never actually run out of credit, always top up in time. That's interesting information for a microfinance organization to say this person's got a good credit history. We can tell exactly what appliance someone is using centrally. We can tell if their mobile phone battery needs to be replaced. We can tell if they're using a really low efficiency television. That's all potentially interesting data for people. So we're very open to sharing that data. So please, if data is interesting, get in touch.
And so I'll open it up to the floor, and you can share ideas about data, or you can ask more general questions if there are any. Otherwise, I'll keep grilling these guys. No, it looks like we have a couple questions here. Great.
Right, so congratulations to the three of you. I've also traveled the entrepreneurial journey and understand the challenges that you're going through. Questions for both Simpa and SolarNow. What are your top three not Simpa, for everybody, what are your top three selling products? And for you, Sam, what is the sales model? Is it a one-time sale that you sell your technology to a microgrid, or is it recurring? But what are your top three selling solar products?
I'll tell you our top one, because we've only got about 4. We try to keep it simple for basically to get more efficiency in our supply chain. But I thought you could hear my shouting. Our number one product by far is a 3-light and a fan system. It's got a 40-watt panel, a 26 amp hour battery. It's got 3 LED lights, each of which is about 5 watts. And it's got a DC fan, which is about 15 watts. So the fan uses 3 times as much power as a light. And mobile charging. That we price at 20 rupees per day. So we charge per day for our systems, and people can top up 10 days at a time, 20 days, 30 days, 60 days.
Do they eventually own the system?
If they want, yeah. There's a buyout price. There's a buyout price at 6 months. It goes down at 12 months. It goes down at 18 months.
So yeah, we actually only sell solar home systems, and although they're modular, so you can buy them in different sizes, it's really one type of product. Maybe to give you a bit of an idea, about 30 to 40% of our clients start with the smallest system, which is a 50-watt peak system with typically six lights, a small radio, the ability to charge your cell phone. And then around 30 to 40% of our clients, they buy the second system, which is then a 100-watt system. And that system typically also then is sold with a television set. And then about 10% of our sales also include a fridge. And that's like how we're kind of expanding the product range, adding appliances like kind of in like order of demand. So actually this week we launched flat irons, which is high on the demand list of typically Ugandans. So we're launching stereo systems soon. We're launching fans, gradually expanding the product range as we go along.
And the costs, like for the 50-watt system?
So the smallest system is around $300, which results in about an $80 deposit, and then $20 per month if you buy it on credit.
So our business model is very much based on the recurring revenue. So we will sell our gadgets that enable it to be an energy vending machine, if you like, practically for cost. And then people pay a monthly subscription to access the dashboard and access the mobile payments integration. So it's a recurring revenue model with us. But in terms of integration with Mum and Mike's, one potentially interesting thing would be the cousin in Washington, D.C. paying for Aunt Nellis's power bill to run her fish refrigeration shop in Kenya. That would be a very, very easy thing to set up. Remittance-based power provision, if you like.
I think there was another question over
Yeah, thank you. I think two of you actually had a very strong opinion about grants. One of them is allergic. And I think you actually figure out creative ways to work it, your way. But if you could, is it really possible that grants are going to allow you to become, that or investment worthy? So for the three of you, what is it really the value of the grants with respect to your ability to gain debt?
I'll just quickly say we've used grants to help us do more than we would be able to do with the capital that we could raise otherwise. So I think we wouldn't be as far along if we hadn't had raised some grants. And we could grow faster if we raise more grants, but we could grow a little slower without grants. So if we are to bring on any more grants, it will be to launch into new territories, to grow maybe double the speed. So if that's meaningful to a grant provider, there's a certain urgency in this problem. People are sitting there in the dark, sitting there without access to energy. We want to move quickly. We're, like you, like I think everybody in the sector, we're in this to build a commercially viable model that does not require grants. But the grants have been very useful for us to sort of bridge certain periods when we've not been able to raise the commercial capital that we need.
What about from the eyes of the investor? Do they really like it, or are they allergic?
Our investors have been comfortable with it, except that with the grant funds, we then get a little bolder and go do something more or try to grow faster. So sometimes investors are worried that we're overstretched, that we've made promises to grant funders that we're going to do X, Y, Z if we take their money. And then, of course, we have to go do X, Y, Z. Equity investors are a bit more flexible. they're more willing to hear that you need to pivot your strategy, that what you thought was the right way to do it is no longer the right way anymore because you've learned something and now you want to do something different. Some grant funders, you commit to a set of milestones, you have to do those, complete those milestones, keep your promise. Others, and Div, to their credit, they have a milestone-based model where you commit to certain milestones. But as we've learned and modified our business model, we've gone back to Div, Development Innovation Ventures, and said, look, we thought we needed to do it this way, but now we're realizing we need to do it that way. Is that okay? And they said, yeah, that's okay, as long as you hit the most important milestones, which is proving the commercial viability, getting more and more profitable, and hitting the customer numbers, then how you do it matters a little less to us. But thanks for coming and asking. So they've been a great partner to work with like that. But I know some companies or organizations that took grant funds and then felt completely constrained to sort of stick to the plan that they gave 2 years ago when they've actually learned that that's no longer the right way to do it.
I can confirm that. I mean, like I said, although we are allergic, I mean, there is a place for it. I mean, if it's really confined, when it helps us build a unique part of the business that otherwise we would have to fund from equity or working capital, yes, there is a place for it. But grant funding is never really free money. I mean, you need to invest as a company to get a proposal together. You need to invest in doing the monitoring and the evaluation. And you have to really think carefully about whether you want to do that as a company and whether you want to build those kind of overheads in your company to do that. If it easily ties into the existing evaluation and performance metrics that you already built for your own company, great. But what we often see is that indeed it creates an overhead a lack of flexibility that you maybe do not want in your company. So if we can fund it in another way, we will look for that option. And even looking at research and development over time, in an ideal world, we fund that from our own revenue streams. So like I said, we are allergic, but if we can give it a good place, of course, we will see if we can incorporate it into the business.
So I'll just like to underline something he said, and anyone out there who's designing grants, take note. Keep it simple. We don't have time to spend 14 days finding our grandmother's mortgage statements. Keeping it simple, at least for the early stages, is critical because it means more people will apply. So we're actually find grants very useful, and it's something that Amit mentioned earlier. For us, grants enable innovation. We're lean as a company, so often can't afford to do some interesting technical development. Grants enable us and give us the space in order to do that. So it's critical, and it's really useful for what we do. Equity seems to be more often earmarked for bringing on key staff and building capacity in that way. But grants, specifically because they tend to be quite targeted to something like technical development, allow us to innovate in ways that we wouldn't otherwise be able to do. So it's a really useful part of the landscape, I think. If it's simple.
Your customers been grant funded too, or are you selling to philanthropic organizations or?
Yeah, absolutely. We have a huge range of customers. Some of the grids that we've built have been raised through crowdfunding, which is really, really interesting. Some have been raised from standard donor-based organizations, and some are purely commercial, E.ON and the likes. So the full flavor, but yeah, as to the extreme of crowd-based microgrids.
I don't want to cut this off because I think it's a great conversation, but I see there's some very nice looking cakes on the dessert table. So I'll take just 1 minute, wrap us up here, and just wanted to point out a couple things. So I think consistent across the panel, we saw that a focus on quality is always important, and all three really emphasize quality products must be underpinning all of this. And then understanding the customers and continuously understanding more about the customers. Some interesting ideas about how we can use data and link that data through to different communication methods to provide greater transparency, and how that's useful not only for managing the company, but also for communicating with partners and investors. Also, all three of these businesses are in very different places than they were a few years ago. In that short period of 4 or 5 years, they've all evolved pretty significantly. So I think we see the need for constant evolution and meeting the customers where they are as a consistent theme. We had a little bit of disagreement and some different opinions around vertical integration versus specialization. And that may be driven partially by where these markets are in terms of their evolution. But I think that'll be a really interesting one to see play out over the next few years as to whether the specialists are able to be successful and operate at scale, or whether companies need to continue down this path of full vertical integration. And then, the main subject here was around asset finance, and we talked about the different uses of capital and blending this. Everyone talked about blending the different forms of capital, about creating the right balance of how to bring those pieces together, and thinking very strategically about the different uses of debt, both short-term and long-term, about how equity plugs into that puzzle, and some good ideas about grants, some good advice that I will take, and I imagine some of you will as well, about how concessional capital can be useful as a part of that broader package, probably not always as a standalone thing, but in order to catalyze some of that further investment. And just to wrap up, it takes time, and I don't want anyone to walk away with too pessimistic of a view, because these companies have been pretty successful at raising capital. I know it hasn't been an easy road, but they've been persistent in doing that and cultivated those relationships and been able to be successful so far. So please join me in thanking all of them, and I'm sure we can continue talking after.